have here Evan Katz, a managing director of Crawford Ventures, a leading Manhattan-based alternative asset investment firm that forms, grows, holds interest in, and raises very substantial investor capital for compelling hedge funds, private equity funds, and other alternative investment funds. An honors graduate of the Wharton School of Business and Harvard Law School, Evan has worked on Wall Street since 2003 and is highly regarded as an expert in alternative asset best practices, institutional investors, family offices, and successful large-scale fundraising. In this regard, he has raised very substantial investor capital and commitments for compelling hedge funds, private equity funds, and early-stage technology and medical life sciences companies. Evan's vast and long-standing professional relationships in the global investor community include high-level relationships with about 1,000 institutional and family office investors worldwide, which collectively has trillions of dollars of assets and allocate hundreds of billions of dollars to hedge funds, private equity, and other alternative investment funds. His investor relationships include many prominent, large, and world-renowned endowments, foundations, funds of funds, insurance companies, multifamily offices, pensions, single-family offices, and sovereign wealth funds, and also many medium and smaller investors as well, including hundreds that specifically focus on or otherwise allocate very substantially to so-called emerging managers. Evan is also a twice elected director on the Hedge Fund Association, or HFA, board of directors, on which he served from 2014 to 2019. Before that, he previously served for 2 years on the HFA advisory board and was also honored with and received the Young Leadership Award at the 2011 Hedge Fund Summit. Over the course of his career on Wall Street, Evan has been quoted numerous times in the hedge fund and finance press, and likewise is a frequent featured speaker and panelist at numerous leading hedge fund conferences, symposia, and webinars, all as an expert regarding alternative investments, institutional and family office investors, successful large-scale fundraising, the state of the hedge fund industry, and hedge fund best practices. He has also received more than 2,000 LinkedIn endorsements by his alternative investment and Wall Street peers as an expert regarding finance, hedge funds, private equity alternative investments, institutional investors, family offices, and successful fundraising. In addition, Evan is also actively involved with, supports, and works with numerous leading hedge fund, Wall Street, and other philanthropic cases, including Hedge Funds Care, Help for Children, on whose Committee of Hearts Evan has been an active member from 2016 through the present. He currently lives in New York City with his wife, Ruth, and as an executive director at Morgan Stanley and their daughter. Now, Evan, thank you again for joining us tonight, and I'm happy to turn it over to you now.
Well, thank you, Courtney, and thank you to the Boston College Investment Club and all of its members and its leadership team. I wish I were there in person, but it's good to be here virtually as well. So tonight, in roughly an hour, maybe an hour and a quarter, we're going to try to take 20 years of hedge fund experience and consolidate it into about 75 minutes or so. Also, thank you to everyone who submitted questions. I am not just saying this, they were excellent questions. So I think we have a baker's dozen. I think we have 13 questions, which I will get to at the end. They were excellent questions, and thank you very much to everyone who did it. So with that, I will dive into what I've called Hedge Funds 101, the state of the hedge fund industry, and how to get a great job and keep it. I have sprinkled in here towards the end a few life lessons that could be some of those valuable things that anyone ever mentioned. They may or may not have anything to do with hedge funds. So if you can stick around till the end, I promise will be worth your while. Here is all my contact information, but before you start typing crazily to copy all of it, there's a QR code at the end. So if you make it to the end, you can just take a snap of the QR code and save yourself a lot of typing. But most of this is on our website as well. We have a bunch of videos on our YouTube channel regarding hedge funds, fundraising, investors. Definitely worth watching all or some of them. And we also have a hedge fund alternative newsletter, which has over 100,000 subscribers. It is one of the most widely read around the world. From Long Island, New York. I went to Wharton, was a finance major there. Spent 3 years in the greater Boston area at Harvard Law School. Actually, back, albeit virtually. The state of the hedge fund industry, things are doing pretty well. Assets under management are now about $5 trillion, and I put in here explain why. And I know I'm sort of speaking, talking my own book, as they say, but the hedge fund industry tends to attract some of the brightest and hardest working people around. Not every fund does well, not every person does well, but they attract some very bright people. The fees can be large, and a lot of people gravitate towards it, which does not mean every fund is going to be successful. Far from it. Whether every person who tries to enter the industry will do well. But there's a lot of creative hedge fund strategies that we'll get into that give people many opportunities to try to prove how well they can do. It's kind of like the BCIC. The numbers don't lie. If you're a baseball player, your batting average is what it is. If you're a hedge fund manager, your performance is what it is. So it is a very objective field. And if you can do well in it, it can be a very rewarding career. Although, as I get into later, try to pay some of that back if you're fortunate enough to do well in the industry. But right now, over $5 trillion, and so far so good. I'll get into the state of the hedge fund industry a little bit, and then I'll sort of go into the bit of the background. Current hot topics, I always say be careful of what's hot. Private lending and private credit is very hot right now, but be careful of what's hot because a lot of things were hot over the course of the past several hundred years. Stocks were hot until they weren't. The tulip bubble was hot until it wasn't. .com was hot until it wasn't. Same thing with subprime and a lot of other things as well. So just a bit of initial advice about what's hot and what's not. There's an old expression, when your bartender starts giving you advice about a certain stock or investment strategy, that's probably a bubble waiting to happen. One thing Courtney mentioned, the introduction, we do a lot of work with established funds and large funds. We also do a lot of work with smaller managers and so-called emerging managers. It is very difficult in the industry to make it as an emerging manager. A lot of the big investors only want to work with the biggest funds, even though the numbers have proven that smaller funds tend to do better. They're more nimble, they're more hungry. But a lot of the big investors want to stick with the name brands. There's an old expression, ask your parents. Nobody ever got fired for buying IBM. So it can be a challenge, and some of the questions I'll get to at the end discuss that. So it is not easy to be successful in the field, especially to start your own firm. Even if you do well, it's another thing to raise capital, and we'll get into that later. But smaller managers tend to do well, but they still have a very tough time raising assets. This year and the last couple of years have been pretty interesting. There was some major regulatory changes that would have happened that the Fifth Circuit struck down. I noticed some of them on the slide, but it's probably a bit too inside baseball. But there were some major regulations that got struck down about how hedge funds would have had to operate. So I mentioned on the slide, but I'll leave it if you want to take a look on your own for another time. So what is a hedge fund? Who started the first hedge fund, and what year did he do so? Normally live, I would ask for a show of hands. We'll get into what is a hedge fund. As I said in the hint, it is the hedge fund diamond anniversary, which I just realized when putting together presentations like this. So in 1949, 75 years ago, Alfred Winslow Jones, known as A.W. Jones, started what everyone says was probably the first hedge fund. It was long short equity and leverage. So long short equity meant they were going long stocks they thought they were going to go up, buying them, and they were shorting stocks they thought that were going to go down. So the concept was to make money or to lose less money, regardless of which way the markets moved. So if the stock market was going to move up and they were long, they made money, and hopefully their shorts made them money as well. And this was 75 years ago. And the concept was to be less correlated, especially in down markets, and to provide diversification to long-only managers and stocks and bonds. Or to put it another way, to try to make alpha. As you probably learned in classes along the way, or you will in business school, beta is the market. So if you buy stocks, beta is the S&P. The market was up, the market was down, that's beta. Alpha is what particular managers or particular funds did, hopefully better than the market did. So again, to sum it up, hedge funds were designed to make money on the longs and make money on the shorts, or at least to provide more diversification So when the market tanks, you're either up a little or down less. And that was 75 years ago in 1949. So since then, there are many, many hedge fund strategies. And I think that one of the surprising things when I entered the industry 20 years ago is there are probably a dozen hedge fund strategies. So I'll explain each one briefly, but the market is wide open to whatever you think you're good at or can prove you're good at. So the first bullet point is long short equity, still number one by far. Long Coke, short Pepsi, what have you. Long Nvidia, short something else, by far the most common. Uh, and then I've also listed some other ones, I think alphabetically. Activist hedge funds, where they're long the company and the hedge fund manager tries to get actively involved, potentially doing proxy battles. It's a fascinating world where they basically try to get board seats and try to take companies with a lot of promise that have been underperforming, change the board, change the management. Fascinating field. I mentioned here algorithmic, quantitative, systematic strategies, basically programming computers to do it better than humans could. Some of the greatest hedge funds are algorithmic and quantitative, but that is not a recipe for automatically being successful. There have been failures in algo and quant funds as well. Convertible arbitrage tries to make money based on differences between the pricing of certain stocks that are convertible stocks, convertible equities. Can be challenging to do. If it were that easy, a lot of people would figure it out, but there are still funds that do it. Fixed income, just that, hedge funds that are trading fixed income opportunities. Global macro, instead of trying to predict what's going to happen with individual stocks, tries to predict what's happening in the world and make trades based on certain countries or certain regions or certain sectors. Managed futures, CTAs, and CPOs tend to do a lot of commodities and FX. So-called market neutral funds try to have zero exposure to the market at all, to be long the same amount that they're short. They tend to try to put up 6, 7, 8, 9% a year with no correlation to the market, and to tell the endowments and foundations, we're going to make you pretty good returns without the risks of the stock market ups and downs. That's market neutral. Our merger arb tries to make money based on the merger of companies. And then there were some sector funds like biotech and technology, which some investors won't invest in and some investors will. And lastly, I mentioned stat arb and vol arb, very algorithmic, mathematically laden areas where they try to figure out the likelihood of certain things occurring in terms of the value of the stocks or the volatility of the stocks and try to make some predictive bets. So those are extremely very different, about a dozen different hedge fund strategies. So there's a lot of interesting firms you can work for or try to build at some point during your career that do very different things. And I'll just mention a few other ones. Nowadays, pretty much anything can be a hedge fund. Artificial intelligence we'll get to later. It's a huge field now. Some hedge funds can trade auto or credit card loans, commodities, oil, gas, gold, silver, cryptocurrency. I never thought I would see the day. BlackRock, Fidelity, Goldman Sachs, JP Morgan, and Morgan Stanley are doing cryptocurrency. Regular currencies, FX, patent licensing and litigation. There are some hedge funds that do life settlement, buying insurance policies to try to predict better when people are going to live or die. There are some hedge funds that do litigation finance, financing mass tort law firms. Some hedge funds do mortgages, and some hedge funds do private credit and private lending. So again, the world is wide open to different strategies in hedge funds, although, as I mentioned later, some of them are probably more private equity-like. So in sum, what is a hedge fund? Anything liquid, typically liquid, but some are more private equity-like. They trade instruments on a market typically or over the counter, not a mutual fund. They typically charge a management fee, 1 to 2% per year. They typically charge a performance fee, 15 to 20% of the profits. And traditionally, hedge funds were the so-called 2 and 20, 2% and 20%. Although, do you really need a 2% management fee to run a $10 billion hedge fund? That's a conversation for another day. Rarely do hedge funds have a hurdle rate where the hedge fund only makes the 20% above the hurdle rate. A lot of private equity funds do, but a lot of hedge funds don't. Can't give a good reason, but historically, most don't. Typically, most hedge funds take money in monthly, and typically they have redemptions or withdrawals on quarterly with notice. So this is the one hedge fund cartoon for the evening, entering Greenwich speed limit 2 and 20. Historically, Greenwich, Connecticut was the original home for a lot of the big hedge funds. It still is the unofficial home for many of the big ones, but frankly, New York City has taken over by far for hedge fund concentration. And of course, there's many in London and Hong Kong, but Greenwich is still the official or unofficial capital of hedge funds. And the speed limit there is 2% management fee and 2%, 20% performance fee. So the interesting thing worth noting, after the financial crisis in 2010, there was a lot of so-called quantitative easing. The government pushed interest rates down a lot. And as a result, the stock market tended to go up at a 45-degree angle. The government pushed interest rates down. It was very easy money, very low interest rates, and many stocks went up, and the market indices definitely went up. And a lot of investors were a little bit upset at their hedge funds because the S&P was going straight up, so to speak. But if hedge funds are truly hedged, and many of them are, it's hard to outperform the S&P when it's a bull market. And a lot of investors forgot about down markets, and a lot of people hadn't lived through them. And so hedge funds came under fire, and hedge fund fees came down. But then came 2023. The S&P was down almost 20% in 2023. And if you were with good hedge funds, they were hopefully down less, flat, down a little, or up. And that's when people realize, yes, the markets can go down and hedge funds serve a purpose. So, one of the lessons about history is people can be very short-sighted and they forget the lessons. And then something happens like 2023, and they remember why hedge funds can be a good diversifier for your portfolio. So hedge fund fees came down. The Greenwich speed limit is probably now about 1.5 management fee on average, and about 15% performance fee. And that's probably where the average is now. But if you're a great hedge fund, then you can charge more. Sometimes you can charge more. So how are hedge funds structured? What types of entities, and how and why are they created? Basically, there is the hedge fund, ABC hedge fund, typically in Delaware. Long story, but that's where most companies are. They've got a big corporate practice in Delaware. There's the IM, or the investment manager, also typically in Delaware. And there's the general partner of the hedge fund, typically Delaware. There's also typically an offshore version of the hedge fund for non-US investors and for non-taxable US investors like endowments, foundations, and pensions. And that's a long story as to why. It's for tax reasons. Sometimes hedge funds run money in so-called SMAs, or separately managed accounts, where instead of investing in a commingled hedge fund, you invest separately. And that is still done. That is still done to this day. And a long conversation. I won't get into it now. One of the things that most people don't realize is it requires a lot of service providers to run a hedge fund. Like any good company, there's a lot of support staff internally and externally that hedge funds need. So I'll mention a few of these because most people don't realize the ecosystem that is the hedge fund ecosystem. First thing are service providers. And there's a lot of them. Hedge funds work with accountants. I mentioned some of the major names here who audit them and do taxes. Obviously, it's important that your hedge fund is audited because you can only attract investors if you are. They have administrators, huge third-party companies who help verify the performance, who take in investor money, who do investor withdrawals. And any major hedge fund these days is going to have a third-party administrator. Otherwise, investors probably will not allocate to them. Obviously, there are attorneys who do both the onshore and the offshore. And I mentioned a couple of the major names here. Obviously, every hedge fund needs a bank. Nowadays, they have compliance consultants. And the major firms typically have cybersecurity consultants, which actually is a major SEC issue. The SEC, Securities and Exchange Commission, used to be concerned with were hedge funds doing things properly from operations standpoint, from a marketing standpoint, from an infrastructure standpoint. And in 2024, and even back in 2020, cybersecurity is actually a major issue. The SEC has actually gotten up to speed, and they now examine hedge funds not only for how they're running the money and protecting the money, but including they have cybersecurity put in place. Because if they don't do it properly, and there's a chance that there could be a breach, a major breach, investors potentially could lose far more money from a cybersecurity breach than by a couple of bad trades. So this actually is now a major SEC issue. A lot of hedge funds also have D&O and E&O insurance, directors and officers insurance, and errors and omissions insurance, which basically protects the fund and its investors from a variety of things that could happen. And hedge funds also have a so-called prime broker. Citibank, Goldman Sachs, Morgan Stanley are some of the big ones through which the hedge funds trade. So the importance of forming a hedge fund and building a hedge fund with major service providers can't be overstated. Investors get hundreds, if not thousands, of pitches a year. And for your hedge fund or the hedge fund you join to stand out, it not only has to have a great team, great returns, but it's got to have at least AA minus B plus service providers like the ones named here, where the investors know that there's a good team surrounding the portfolio manager and the investment team. I should also say a lot of these names on this slide, especially the law firms, publish a lot of interesting articles on what's going on in the hedge fund industry, especially the law firms. So if you take a look on some of their websites, you can probably see some very up-to-the-minute research on what's going on in hedge funds, which is why I put down some of the names. So who works at a hedge fund and what does each person and role do? Obviously, there's the portfolio managers at the hedge funds, the so-called PMs, the ones who are basically leading the firms, making the investment decisions and so forth. And I guess similar to how BCIC helps run some of the endowment money. The portfolio managers are the generals. They're supported by a team of lieutenants, corporals, and so forth. In the hedge fund case, a team of analysts who do a lot of the research. Nowadays, especially for quant funds, but even not just for quant funds, information has become critical. So 20 years ago, there was not a lot going on with computers at hedge funds. There is now. A lot of the hedge funds have quants who are doing coding and models and data aggregation. And obviously, they have a chief financial officer, chief operating officer, back office, traders, chief risk officer, and general counsel, or at least the big funds do. If a fund is starting out, they're not going to have all these functions in-house, but at a certain point, investors are going to expect you to have all or most of them in-house. So now that we know who is working at a hedge fund, what each one of them does, and who the service providers are, what are some of the principal documents hedge funds have? So these are pretty much the principal hedge fund documents. There's the one pager, the so-called tear sheet, which is basically a summary of what the fund does, their performance, their strategy. Think of it as basically your hedge fund baseball card. The baseball card says who the player is, some statistics, some background, their batting average for each season. Same thing with the one pager for the hedge fund. The second thing is the PowerPoint, otherwise known as the pitch book. That is roughly about a 15 to 25 slide PowerPoint that discusses, from a marketing high level view, everything about the team, the strategy, the biographies, where they came from, how they hope to make their money, what the risks are, how they mitigate the risks, who the service providers are. So I would say the one pager is the baseball card. The PowerPoint is sort of the elevator pitch. It's the 15 to 25 slide, 5 or 6 bullet point regarding every topic about the fund, the team, the strategy, the risks, and the service providers. Then there's the private placement memorandum, or the PPM. That is essentially somewhere between a 50 and a 100-page legal document, which goes through everything in excruciating detail, including, because it's drafted by lawyers, everything that might go wrong and could go wrong. And it's about 50 to 100 pages. And that I've put together a few of these. That is a major project to put together. Then there's the limited partnership agreement between the fund and its limited partners, the investors. Again, a 30, 40, 50-page agreement. And then there's the subscription documents, or so-called subdocs, when an investor wants to invest, that he or she or it or they have to fill out. And then there's the investment management agreement between the investment advisor and the fund. And lastly, there's the virtual data room, or VDR, which contains all of the above, plus copies of the fund's audited financial statements, Form ADV, Form PF, and you can Google those if you want. So in sum, there's probably a couple of 100 pages of documents that a hedge fund has for their hedge fund. So a lot of paperwork. So some of the questions that I was asked, I will get to them, talk about or ask about investors. What invest in hedge funds? First thing I can recommend, there's a link to a video regarding fundraising, if anyone's interested in the fundraising aspect, and a 55-tip PowerPoint at the other link regarding how to best raise money for hedge funds. So we've discussed the history of hedge funds, the types of hedge funds, who works at hedge funds. Let's also talk about who invests in hedge funds. So some hedge funds are individuals. U.S. individuals are all taxable. They invest onshore in the Delaware entity. There can be non-U.S. individuals who invest in the offshore or Cayman entity in order to avoid U.S. withholding. High net worth families, so-called accredited investors, and so-called family offices, those who are so wealthy that they have their own internal investment staff on site, and those are single family offices, multifamily offices, and there are some investor clubs. Tiger 21 is one of the biggest one. I think they have hundreds, if not over 1,000 families, and they look at hedge funds and other investment opportunities together. So hedge fund investors can be individuals, and of course they can be institutional. So the institutions, there are varying types. There are endowments. Various endowments have millions, if not billions of dollars. They invest offshore. I'll skip over first loss, but it's an interesting thing. You can Google what first loss investors do. There are foundations, charitable foundations that invest millions and billions of dollars in hedge funds. There are so-called funds of funds that invest in hedge funds. Insurance companies invest in hedge funds. There are OCIOs, outsourced chief investment officers, who advise endowments and pensions and foundations to invest in hedge funds. There are public and private pensions that invest in hedge funds, and seeders, you can look that one up, that invest in hedge funds as well. So, for example, there's the Boston College Endowment. All the major universities have millions and billions of dollars allocated to hedge funds. There are charitable foundations and public and private pensions alike. So, the big four, Fortune 100 and 500 companies, some of them still have pensions. They invest in hedge funds. But then also, people don't often think of it, the public pensions. So biggest ones are, your local police, teachers, and fire pension. So, New York, for example, New York City, New York State has many billions of dollars in pensions for the teachers, the policemen, the firemen, and they invest in hedge funds through there as well. So a lot of people are invested directly or indirectly in hedge funds, either directly or have pension holdings in them. Another question comes up, okay, who regulates hedge funds? And this is an interesting one. Who regulates hedge funds? The answer is it depends. So it depends on what they trade. So for example, most hedge funds trade equities, stocks. If a hedge fund trades stocks, they are regulated by the United States Securities and Exchange Commission, or the SEC. However, if a hedge fund trades commodities and futures, they are regulated by the CFTC, the Commodity Futures Trading Commission. Okay, great. What if you and I put together a hedge fund that trades rare baseball cards or rare wine? The answer is we don't have a regulator. Uh, it's interesting. Most people don't know this. If your hedge fund trades baseball cards or rare wine, it's not an equity. So the SEC doesn't regulate you. You're not trading commodities or futures, so the CFTC doesn't regulate you. So your baseball trading card hedge fund has no regulator. But as they say in the last bullet point, the SEC always has anti-fraud jurisdiction. So what does that mean, anti-fraud jurisdiction? It means that if your rare baseball card lies to your investors, the SEC has jurisdiction to come after you. So your regulator depends upon what you trade. So, one of the things I get into at presentations like this a bit towards the end is hedge fund blowups. And this is an interesting topic, and I try to focus on the positive, but there are and always have been and always will be hedge fund blowups. So, what exactly is a hedge fund blowup? A hedge fund blowup is not a hedge fund losing a little bit of money or some money. It's a hedge fund losing a lot of money, a really lot of money. Something really goes wrong. That's why they call it a blowup. And there are some incredible life lessons in here that apply maybe not just to hedge funds. So the first bullet point is let's talk about a hedge fund that blew up because all of their investments were bad or wrong. And I say in all caps, never. Now, I'm sure it's happened somewhere, but let's say never. The point I'm trying to make here is in my 20 years in the hedge fund industry, I have never seen a hedge fund that has a diversified portfolio across numerous stocks or bonds or whatever they're trading with reasonable amount of leverage or borrowing that has stop losses and that got all of their trades wrong and blew up. I'm sure it's happened somewhere. I've never seen it happen. What always happens, and I say it here in all caps, are the basic stupid mistakes. So if not 100, 99% of hedge fund blowups where they really lose a ton of money and go under are hedge funds that are too concentrated in very few positions, too concentrated in a few sectors, too much leverage or borrowing, or far too much, or not having hard stop losses. And sometimes it's all or most of the above. So probably most people on this Zoom, if you're in college, do not remember or were not following in 2008, 9, and 10 when Bear Stearns and Lehman Brothers blew up. Now, Bear Stearns and Lehman Brothers were two of the largest firms on Wall Street. And if in 2007 you bet someone or told someone that Bear Stearns or Lehman Brothers were going to be bankrupt within 18 months or so, you would have been committed for being certifiably insane in a second. And if you had bought deep out of the money puts or credit default swaps on Bear Stearns and Lehman Brothers, where you would have profited if they went bankrupt within 2 years, you would have made millions, if not tens of millions of dollars. And yet, within 2 years, Bear Stearns and Lehman were bankrupt and went under. So what happened to Bear Stearns and Lehman Brothers? If you don't know, one of great life's lessons. The subprime craze was happening. Everybody was investing in subprime mortgages. Going back to the hot, trendy investment topic from before, everyone was investing in subprime mortgages. And everything went great until it didn't. And Bear Stearns and Lehman had a lot of exposure to the subprime industry. And they had too much exposure to the subprime industry. And they also had a lot of highly levered exposure to the subprime industry. And when you leverage, again, is borrowing money to make investments. And if you borrow money to make investments and the investments are profitable, well, you've made a lot more money. But if you borrow money to make investments and the investments lose money, you lose double the money. So as I mentioned in the last bullet point, there's a great book called When Genius Failed. It's about long-term capital management. It was one of the most famous hedge funds. It had a Nobel Prize winner. and it blew up. And it's called When Genius Failed. It's a great read, highly recommend it. So it's about how the fund had brilliant people, but they were levered 20 to 30 to 1, meaning they were borrowing 20 or $30 or so to make $30 of investments instead of $1 of investment. And the problem is, if something goes wrong when you're levered 20 or 30 to 1, you're in trouble. It's kind of like if you're driving your car or your motorcycle on the road at 30 or 40 miles an hour, you can navigate and get around pretty much any pothole if you're going 20 to 30 miles an hour. You can go around the pothole, you can go over the pothole. But if you start going at 80, 90, 100, 120 miles an hour, it's a lot harder to go around the pothole or to go over the pothole without wiping out the same size pothole. And that's what happened with Bear and Lehman and long-term capital. Heavily concentrated, heavily levered. What could possibly go wrong? And what went wrong was something went wrong that should have caused them to lose some money, but they were highly levered and they were highly concentrated and they went out of business. So not to spend too much time on the downside, but there's some incredible, life lessons here. The next slide, not to spoil the party, I always want to mention something about hedge fund frauds. They're few, they're far between, but I'd be remiss if I did not talk for an hour or so about hedge funds and did not mention that they do exist. And sort of akin to the last slide, where I've never seen or heard of a hedge fund that blew up who was diversified across sectors and companies and had stop limits. The first bullet point says highly sophisticated hedge fund frauds. Now, I'm not going to say never, but I said rare. Incredibly, the hedge fund frauds, and I mentioned a few here that I'll go through, if not all, almost all of them, were simple, detectable frauds. So I'm sure everyone's heard, regardless of the age of the people on the Zoom, Madoff. Bernie Madoff, $65 billion Ponzi scheme, the greatest by far in the history of the world. And so I say here, Bernie Madoff was self-administering. What in the world does that mean? Well, remember a bunch of slides back, I said every hedge fund has an independent third-party administrator who computes how the fund has performed, who takes investor money in, who does redemptions, and basically is an independent check and balance, if you will, on the hedge fund manager that what he or she is saying is accurate. Bernie Madoff self-administered, meaning Bernie Madoff was his own administrator. So, right now I'm part of a very high-performing hedge fund. And as I like to say, we don't tell investors what our performance is for October, September, what any month. Our administrator does. But Bernie Madoff was telling investors what his returns were. And he was lying for years, a $65 billion Ponzi scheme. Now, most investors would never invest in a hedge fund manager who is self-administering and saying what his or her own profits were. But because it was Bernie Madoff, the former chairman of NASDAQ, people did. And it was a $65 billion Ponzi scheme. I'll go through one or two more because the lesson here is, again, most frauds are so ridiculously simple to catch. Pedders was a $3.65 billion Ponzi scheme. He was raising a hedge fund that did factoring on receivables, meaning certain companies had orders from customers. The hedge fund would lend the money on the receivables. The money comes in. What could possibly go wrong? Well, Pedders was a $3.65 billion Ponzi scheme. Either all or some of the orders were fake. He was forging documents and faking orders. Again, easily detectable if you just check and insist on checking with the people that he's dealing with, the people who are placing the orders or the companies that have the orders. $3.65 billion Ponzi scheme. The next one I mentioned is Rothstein. This was only, and that's in air quotes, of course, on Zoom, only a $1.2 billion Ponzi scheme. Rothstein had a hedge fund that was investing in legal settlements. There were legal settlements. People agreed to pay. Everything is secured. Everything is easy peasy. What could possibly go wrong? Well, what went wrong was that Rothstein was lying about not all, but some of the settlements and making them up. And again, the investors never said, I need the list of the law firms who were doing the settlements, and I need to check with them. Simple phone call, simple email would have revealed it. So basically, as I say in the italics here, almost all the hedge fund frauds are very easily detected if investors had just checked with independent third parties. So I'll move on from the frauds. We'll get back to hedge funds. So now I'm going to turn to what a lot of people in undergrad or MBAs are interested in as well, how to get a great job in hedge funds, how to advance in their careers, what to do, what not to do. And there are going to be some things in here that are worth the price of admission. And I can guarantee you will save most, if not all of you, from making some mistakes, or conversely, will help you be very successful. And I can guarantee that. So how to get a job in hedge funds if you're interested. I mentioned in parentheses, LinkedIn and recruiters are when you already have some experience. So make a note, LinkedIn and recruiters are great. But when you're first starting out, they're probably not going to be for you. They want people who've got experience. So one resource I mentioned is Alborn Village. They have hedge fund news and job news. Highly recommended. It's a free subscription, Alborn Village. LinkedIn, again, is wonderful. They have a ton of hedge fund jobs, but that's typically for more experienced people. Same thing with recruiters, but make a note. I put down the names of about 5 or 6 of the most prominent hedge fund recruiters. When you get some experience, if you want a job in hedge funds, go back to the PowerPoint and contact them. Bullet point number 4 is pro tip. If you ever want a job at hedge funds, do an advanced search on LinkedIn for senior people who work in hedge funds and also went to your college too. That is a great way to get a job in hedge funds. Most people will take the call and they will take your call when you call them. Excuse me. Still getting over a cold from last week. Trade organizations. Join, attend, and network, and eventually seek a leadership position. I put down there the names of about 5 or 6 great hedge fund organizations. Definitely worth joining them. Excuse me. AIMA, the Alternative Investment Management Association, California Alternatives, the CFA of New York, Connecticut Hedge Fund Association, the HFA, the MFA, and the Texas Alternative Association. They have great resources. Definitely join them. Some have student rates, and keep them on your radar screen. They can be an invaluable resource to you as you learn about hedge funds and try to potentially get a job in one. 6 random bullet points or so. How to keep a hedge fund job or any job. Things I wish people had told me before I started my career. The first bullet point is obvious. Do an exceptional quality job at your job. Do great work. Obviously, no explanation needed for that. Second one, a bit more subtle. Brainstorm, find and do additional projects you were not assigned. In other words, be the proactive one. Be the one who goes above and beyond the call of duty and tries to add as much value as you possibly can, even though it's not your job. The third bullet point, if possible, be a revenue generator. Having clients or helping make the fund money or whatever company money is often the best job security you can have. If you're making the company a lot of money, you probably got a good job. You'd be the last one to be let go. Bullet point number 4, do your job well, be on time, and even the most annoying part of the job. Every job has its fun parts and its annoying parts, things like expense reports or timesheets. And some people kind of push back on some of the more annoying parts, but as part of the job, you've got to do it. The next bullet point is a little self-explanatory: attitude. It says the PIA people get laid off first. You can Google PIA, you probably know what it means. Don't be the person with the bad attitude. And the last bullet point is, I'll explain this one. Don't be your boss's dinner table conversation. And then a few critical life lessons, a couple of random things as well. Number one, this is probably the $64,000 idea. Take notes on business cards when you go to networking events. I've probably been to literally over 1,000 networking events in 20 years in hedge funds. And people still have business cards and they come back from the event with a stack of 30 or 40 cards from everyone they've met. But they haven't taken any notes on the business card as to who said what and what they're supposed to do and which one was important and which one wasn't. I will jokingly say, if you remember one or two things from this presentation, this is one of them. When you go to a networking event and you've met a ton of people, make notes as to who does what on the business card. So the next day, you'll never be able to remember otherwise who you're supposed to follow up with, what you discussed, and what the follow-up items were. Number two, get a mentor. Ask a leader in the industry if they will give you 15 minutes a month or 15 minutes every other month. Most people will say yes. People like to mentor people. Maybe again, someone from your college or from your industry. Most people do 10 or 15 minutes every month or so. Ask them, and they'll typically do it for you. The next bullet point I'll explain: diversify stock in your company. If you ever are fortunate, which I had once, to form a company, which I did, that was very successful, and you end up having 90% of your net worth in your own company stock, diversify. Please, please, please diversify. No matter how much you love your company, no matter how much you believe in it, because things happen. Wars happen. Companies go out of favor. Sectors go out of favor. If you have you would never take 90% of your money and put it in one company stock. You would never do it in a million years. But conversely, if you build a company and you end up with 90% of your money in that company, take half your chips off the table, diversify. One of two things will happen. Your company will be insanely successful, you'll make a fortune, and you could have made double the fortune, but that's not horrible either. Or the converse. Something happens, your company ends up in trouble, and thank God you took half your money off the table and didn't lose it all. So diversify if you ever have all your money in your one company stock. The last bullet point, number 4, I threw it in here. Dating, marriage, and kids. Enjoy Boston, New York City, wherever you end up. But don't get too caught up for too long in the Boston scene, the New York City scene. It's fun, have fun, but life can quickly pass you by. So wherever you end up, whatever city, enjoy it, have fun, but keep an eye on the clock. Life can pass you by a bit too quickly. For follow-up advice and questions, this is the famous QR code. If you take a snapshot of the QR code, it should come through and the PowerPoint is distributed, and you will get all my information and save you from having to retype everything. If you do email, please email next week so everyone doesn't email tomorrow. And if you do not hear from me after 2 weeks, please follow up. I get hundreds of emails and I'm working 80 hours a week. I will try to get back to everybody. But if you didn't hear from me after 2 weeks, please follow up and do not take it personally. So we have a bunch of questions that people ask that are great questions. And I'm just trying to fiddle with the screen here and a couple of other documents I did. So give me just 1 second to move a few things around on the screen. So the first question, well, I'm not going to read it. You can read it here. What role do alts play in your investor strategy? So I'm going to give 2 answers. The first thing and again, great questions. Thank you to the BCIC and its members. Great questions. Generally, alternative investments, which basically means hedge funds, private equity, and venture capital, are designed to give investors diversification beyond stocks and bonds. I mean, what does the name mean, alternative investments? Alternative to what? Alternative to stocks and alternative to bonds. So they're supposed to be diversifiers. So hedge funds, long, short, what have you, have less, hopefully, in private equity, hopefully less correlation to the S&P than pure stocks and bonds. So all are supposed to be diversifier. And then how do I determine which ones are worth exploring? Same as my investors. Do they have a good team? Do they have a good track record? Do they have quality service providers? Are they responsive? Are they forthcoming? Do they provide documents when you ask them for documents in a timely manner? So, how I evaluate hedge funds and private equity funds are the exact same things that my investors. I put myself in their shoes. If my investors are going to love a fund, I love a fund. If my investors are not going to like it, I'm going to be the same way. So, great question. Number one, their alternatives are diversifiers and find them with good teams and good track record. Number two, ESG. How does ESG play into things with hedge funds and private equity? So I'm going to break down the question into ESG and D&I. So ESG is a tricky one. I mean, hedge funds are a challenge. There are some ESG hedge funds, not many. They don't invest in certain things, tobacco, alcohol, maybe, and other things. There's not a lot. There are some private equity ESG hedge funds that similarly do not invest in the so-called sin companies, alcohol, tobacco, and some other things. There are some, but not much. And part of the reason I think is that there's not a lot of things on the sin list, and everybody still wants to make a lot of money. And performance is always number one. It's not the only thing, but it's always number one. But I will say something about D&I. No surprise, as everybody knows, business and especially Wall Street was typically the old boys network. It was mostly a lot of white dudes on Wall Street. There's a well-known group that used to be called 100 Women in Hedge Funds. And they started the group because back in the day, there were literally only 100 women in hedge funds. Thank God that has changed dramatically. By no means yet 50-50, but much more than when I first started in the industry. So when it comes to ESG, I'll say this much. Investors now, many of them, especially the big public pensions, are now looking at hedge funds and other types of alternatives funds from a D&I perspective. One of the factors they consider, great team, great track record, great service providers, et cetera, et cetera, et cetera. But one of the factors now is, do you have some diversity or much diversity? Are they women owned? Are some of the people in the C-suite women? Are some diverse in terms of ethnic background? And it doesn't have to be 50-50 men and women. It doesn't have to be what ideally it should be someday. But, is it anything but all white guys at the table? And that's not to say they won't invest if it is, but it will help you a lot more. And not to mention, I mean, it's not just a quota system. The incredible wealth of talent out there who are not just white guys at the table is extraordinary. So my wife and I have a daughter, and I look forward to the day when she is running a business or running a hedge fund or doing whatever she wants to do. And same thing here. Pensions are looking at it a lot more closely. They want things to be a lot more diverse in terms of gender and ethnicity. So ESG less so, but definitely a lot more from a D&I perspective. Question number three, what role does AI play in informing investment decisions and growing funds? I never usually mention it, but I actually did a lot of work in artificial intelligence years ago when nobody knew what artificial intelligence was, unless you were a professor at MIT or Carnegie Mellon. Without overstating it, AI is one of the biggest changes in the hedge fund industry in a variety of ways. So, for example, at this point in my life, when I want the answer to a question, I do not Google it anymore. If I want to know where is the Boston College website, yeah, I Google it. Boston College, show me the website. But if I want an answer to a question about life, about science, about finance, about law, about compliance, about accounting, I don't Google anymore. I ask ChatGPT. And yes, of course, double check its work, but 90-some% of the time, it's spot on, spot on. So artificial intelligence is revolutionizing the world, including revolutionizing the hedge fund industry as well. So we are seeing a ton of funds that are putting artificial intelligence to work to identify investment opportunities, things that human beings never would have found. Now, does that mean every AI hedge fund is going to do well? No, absolutely far from it. But there are some phenomenal, just like there are some phenomenal quant funds or algorithmic funds or other types of mathematical funds, there are some incredible artificial intelligence hedge funds that are finding cause and effect and things in the data that no human being ever could possibly find. And I think without exaggeration, AI is going to be one of the biggest changes to hedge funds and the world at large. But again, that does not mean to throw your money at anything that is AI and hedge funds, although some people I'm sure are going to make that mistake. So that's the answer to question number three. Question number four, what advice I would give to someone looking to move into alternative asset management straight out of college? I'll give the short and the long answer. My short answer is one word: don't. Do not move into alt straight out of college. I would say far better is to build a career on Wall Street by getting the best job you can find at the best name brand Wall Street firm, the best thing that looks good on your resume: Citibank, Goldman Sachs, Credit Suisse, BNP Paribas, you name it, any of the major firms, major global Wall Street firms. Get the training, go into the analyst program, get incredible training, build relationships you'll have for the rest of your life, potentially. Get it on your resume, learn a lot, and decide maybe you want to stay there. Maybe you don't want to go into alternatives. Maybe you want to build a career. It's public record. My wife's had one job since getting her MBA at Clark University in Worcester, Massachusetts. She's been at Morgan Stanley almost 20 years. Promoted 7 times. That's the only job she's had. Now, I'm not saying that you have to live and work and die at the only job you've ever had out of college, but what I am saying is it may be a phenomenal career and the only job you ever have. And even if it's not, it'll be on your resume forever. And just like, you go to a great school like Boston College, people will see, you spent 3, 4, 5 years at a major shop, Goldman Sachs, Morgan Stanley. It's credentials on your resume. Now, at that point, if you want to go into alternative investments, at that point, pull out and dust off this PowerPoint, look at the resources I provided on the LinkedIn, the recruiters' names that I gave, the tips like going onto LinkedIn and finding the names of people in hedge funds who went to your college. Because I'll put it this way, you can always get more narrow. You can always start out with a great resume, top person at Goldman, Morgan, what have you, and then go more narrow. It's hard to go narrow and then go more broad. So again, question number 3, I would say don't go straight to alts, build a great career, and then see what you want to do after that. Question 5, how did your experiences at Wharton and Harvard Law shape your career in alts? That's a good question. Well, obviously, initially, Wharton provided a very solid, finance background to me. And, that was extraordinarily helpful. It was a phenomenal finance background, great training, learned an incredible amount about finance and investing at Wharton. Harvard Law was probably the opposite side. I forget which is left and which is right brain. But the math quant part was Wharton, and the other side of the brain, analytical thinking, quality writing, persuasive speech and argument in paper and orally. That was probably the Harvard Law School piece. But I will say one thing. Oftentimes, law is the career for people who don't know what they want to do with their career. It's 3 years. It's a lot of opportunity cost, and it's a lot of money. Don't go to law school because you don't know what you want to do. Unless you've interned at a law firm or your mom or dad's a lawyer and you're sure you want to do it, intern before you go to law school. It's a lot of time and a lot of money. I'm glad I went, but it's not going to be too relevant if you want to get a career in alternatives. Question 6, what trends am I seeing in hedge fund fundraising, especially with institutional investors and family offices? Great question. The last 5 years, there's been a continued flight towards quality, a flight towards bigger funds, increasing due diligence. still the continued, I'll say, prejudice against smaller managers. And that's totally a CYA thing. You can Google that term if you don't know it. We're basically, you know, smaller managers tend to outperform bigger ones. But if someone's working at an endowment or a foundation or a pension and they invest in a big fund and it doesn't do well, well, they invested in the big name brand fund, it didn't do well. But if they invest in a smaller manager that didn't do well, they get blamed. So this is well documented. So a flight to quality, the bigger managers, tons of due diligence. But as mentioned before, the smaller managers do tend to do well. Again, also a little bit more emphasis on D&I. Investors want hedge funds to be a lot more representative of the country, of the world, than they used to be historically. Question 7, how do you evaluate and select emerging managers when deciding? Yeah, emerging managers are tough. The days of build it and they will come used to be the case. When I started 20 years ago, if you had two guys, a gal, a dog, and a Bloomberg, and you put up some good numbers, you could raise $1 billion. Those days are long gone. Long, long gone. So the challenge is, I just said 30 seconds ago, that investors want a great team, a great track record, big service providers, tons of infrastructure, and all these things. And the question is, well, if you're an emerging manager, how can you have all those things without enough assets to pay for them? And that's a great question. And that is the challenge. So the most important thing, aside from great team and great track record for emerging managers, is do they have a cash reserve, or call it a war chest, to stay the course and build out a hedge fund? So the great thing about the hedge fund industry is that you can start it, you and your buddy, and a Bloomberg terminal in $1 million, and you can start a hedge fund. The bad thing is what happens from there. So to put it in baseball terms, not sure if we have any Red Sox fans here, but in baseball terms, it is very easy in hedge funds to get to first base. Very easy to start a hedge fund. The problem is, how do you get to second, third, and home? Meaning, you got your $1 million. How do you get to $1 billion if no one invests in emerging managers, where it's really tough? So the trick is, do not start your hedge fund until you've got a couple of $1 million that you can use to market and build and hire people and stay the course. As I like to say, you or I would never open up a store or a restaurant unless we had a couple of $1 million, because it takes a couple of years for the store to become popular and the restaurant to become popular. So we lose money in year 1, we lose money in year 2, but then we become profitable. Same thing with hedge funds. It takes a couple of years to build it. So don't launch your business till you've got enough dry powder, enough of a war chest to make it go further and be successful. Question number 8. 1 second. Question number 8. The most critical factors for successful large-scale fundraising campaign. Okay. Most importantly, hire a great fundraiser. I happen to know a real good one. So hire a great fundraiser. Otherwise, forget it. It's not going to happen. Hire someone like me who knows hundreds of investors for 1 or 2 decades, because if someone's invested 20 years to build up relationships, as I have, don't try to do it on your own. It's hard enough running the hedge fund. You can't be spending 80 hours a week doing research, or 70 or 60 hours a week doing research, and 50, 60, 70 hours calling investors. Hire someone, a top fundraiser, who already knows the investors. It'll jumpstart your fund by years, if not a decade. But in addition to that, there's other things too. When you hire a great fundraiser, take their advice and listen to what they have to say. So, for example, I've done fundraising for numerous hedge funds and private equity and venture funds, and most bring me on board and then take my advice because that's why they brought me on board. There's a famous Steve Jobs quote you may have heard of. He may have repeated it, or he may have invented it. The Steve Jobs quote goes, we don't hire brilliant people and tell them what to do. We hire brilliant people so they can tell us what to do. It's the same thing when you hire a great fundraiser. Obviously, you have conversations and it's a two-way street. But when they give you suggestions on what to do, seriously consider them. Some of the most successful fundraisers I've done were I improved the documents, I improved the processes, and we worked together as a team, and it went incredibly well. The one or two situations where it was a disaster, whereas I told the team exactly what to do and why, and they pushed back and didn't want to do it or got lazy, and I was telling them exactly what to do, and they didn't do it, and surprise, surprise, it was the rare case where the fundraising did not work out. So hire a great fundraiser, listen to him or her, make them an integral part of the team along with everybody else, and and be patient, and hopefully it should go well. Question 9, how has the hedge fund industry evolved in the past decade, and where is it going in the next 5 to 10 years? So the past decade, I mentioned a bit of this before, but let me pull it all together now. The past decade, fee compression. Hedge funds used to be 2 and 20, 2% and 20%. A lot of them are now 1.5 and 20. But if you build a successful fund, that's more than enough money. Also, more regulation. In spite of the recent one regulation I mentioned earlier that was overturned by the courts, much more regulation. So fee compression, which reduces revenues to hedge funds slightly, more regulation, which increases costs, more due diligence, which increases costs. And when you have less revenue and more expenses, it makes it harder to become a profitable hedge fund if you're small. When I started out 20 years ago in the field, give or take, you could be a money-making hedge fund, meaning for yourself as a manager. If your investors were making money, you were profitable running $50 million, something like that, maybe even 25 when I first started. Let's say $50 million. Then the number became 75 million or 100, and now it's probably greater than that. So that's what's happened over the past 5 or 10 years. What's going to happen in the next 5 to 10 years after this? There's the famous Yogi Berra quote. Google Yogi Berra. If you don't know Yogi Berra, Google him. But his quote was, "I'm not good at making predictions, especially about the future." And that's true too here. But I do have one or two guesses. Going back to AI, absolutely AI. It has changed the world. I mean, ChatGPT has changed the world in the 1 year, I think just 1 year since it took off. And I think the same thing is going to be with hedge funds as well. I don't want to overstate it, but I think that's going to be one of the biggest things in the next 5 to 10 years is AI. And probably the best thing is going to be man and woman and machine, so to speak. Like any other relationship, even some of the best quant funds, computers are great at doing things. AI is great at doing things. But with some human oversight, it'll probably be the best. So definitely AI for where we're going in terms of moving forward. Question 10, best practices for managing relationships with institutional investors and family offices. Again, thanks to BCIC. Phenomenal questions. Great questions. Thank you. Managing relationships with institutional investors and family offices. Some of this should go without saying, but I'm going to say it. Number 1, always be 100% honest, truthful, and forthcoming. Always communicate, even when things are not going well. So, for example, if I ask 100 people or 500 people at a hedge fund conference, what's the number one reason why investors redeem or withdraw or pull out of a hedge fund? Most people are going to say the number one reason why people withdraw, redeem from a hedge fund, and pull out is bad performance. Great answer, great guess. It's wrong. That is not the number one reason. It's number 2 or 3 or 4. I think number 2 or 3. The number one reason why people withdraw and pull out of a hedge fund is because communication is not good. And surprisingly not, that's usually when things are not going well. So unsurprisingly, when things are going well, hedge fund managers communicate a ton how everything's going great. But the moral of the story is communicate well when things are good, but communicate even more so when things are not going well. And it's going to happen. It's sort of like boyfriends, girlfriends, husbands, and wives. It is easy to communicate when everything's going wonderfully. It's a no-brainer, not a problem. The challenge is when you're disagreeing, when you're having problems, then you've really got to try to communicate and make things work in that relationship. Same thing with investors. So be honest, be truthful, communicate when things are well, and especially when they're not going well. And I always say to managers, the three rules of investors: tell investors what you're going to do what you told them, and if you're ever not going to do what you told them, tell them in advance, in writing, and why. So that's also probably good for most relationships as well. Question 11, can you share a memorable experience overcoming something during a fundraising campaign? Oh yeah, there will always be something. There will always be something. I guess my favorite example was many years ago. There was an investor. It was a big investment coming into a fund. Forget the exact number. It was a big check, a big wire, and they had approved the investment, but they wanted more transparency about the hedge fund's investments, meaning in the actual positions the hedge fund was invested in. And the manager didn't want to give it. The investor was demanding it. And so, we were at loggerheads. And everybody in the team thought the big investment and the big investor were just not going to come in. The big investor wanted real-time transparency, or much more transparency into the underlying portfolio that the manager didn't want to give. So everyone was writing off the investment because you can't be half pregnant. You can't give transparency and not give transparency. So I said, give me 48 hours or 24 hours. Let me get back to everybody. And I came back to the investor and the manager and did some, if anyone knows Henry Kissinger, the diplomat who passed away, some Henry Kissinger shuttle diplomacy, so to speak. And I went back and forth with both and crafted a compromise where the manager would give some transparency in real time and some transparency over with a 90-day lag. And the manager's prime broker or administrator would confirm that they were doing what they said they were doing. Basically, to make a long story short, it was a big compromise. It wasn't full real-time transparency, but it was some with a lag, and some where some of the third-party service providers would verify what the manager was saying. And I did some shuttle diplomacy, and I ran it by the manager, and he was like, okay, I can do that. And I ran it by the investor, and they were like, okay, I can do that. And the money came in. It was one of the more creative things, and everyone had written off the money and written off the investor. And that was probably one of the more memorable experiences. Question 12, how has philanthropic organizations like hedge funds care, help for children, influence finance and investing? Well, I'll put it this way. And this is sort of hopefully what people already know, but I'm going to underscore it. Hedge funds care, help for children, raises millions of dollars to fund organizations that help children who are victims of child abuse, and to help organizations try to prevent child abuse. So I and probably most people on this Zoom were blessed by I had incredible parents, could not have asked for anything better. The furthest thing from what HFC, Hedge Funds Care, Help for Children, deals with. So, organizations like this just underscore how lucky I am, A, to be born into a wonderful family with incredible parents, and B, to have been given the opportunity, some luck, some hard work, to be in an industry where a lot of people do extremely well financially. So hopefully your parents have said this. Hopefully you've realized it on your own. But if you're ever blessed to be in one of these situations, give back. I mean, there are some incredible charities out there that basically try to make the world a better place now and to leave the world a better place when we're gone. And whatever percentage of your income you give, pay it forward. If you've been blessed to a point where you can make a lot of money, give back as much as you can to make the world a better place. But that's sort of the type of thing that Hedge Fund Care and other charities we work with have helped influence, what I do. Uh, and when you're starting out, also, you can also do well and do good at the same time, meaning there are some incredible leaders of the industry who are part of these organizations, not just HFC, but also Robinhood. Robinhood's another great hedge fund charity. I should also mention um, the Evan Sohn, SOHN, the Evan Sohn, SOHN organization. So when you're starting out, you can get involved. You can help with the charitable events. You can meet some great people. You can donate some of your salary. Obviously, you're starting out. You can only afford so much, but you can do well and do good at the same time. Definitely look up HFC, look up the Sohn organization, the Evan Sohn organization, and look up Robinhood as well. They do some incredible, incredible work. And then I think the last question, and I'll take some additional questions if anyone's got any. The Baker's Dozen lucky question number 13. Given your extensive global network, what differences do you notice in investor behavior across regions or type of investors? Another great question. Thank you, BCIC. I would say two things. May not be surprising, but let me just put it out there. The US and the major financial markets, think London, think Hong Kong, tend to be slightly more sophisticated and slightly more risk takers. Not crazy risk takers, but slightly more developed, putting money to work, reasonable risk-adjusted returns, hedge funds, private equity, venture capital. There's a great expression I heard only maybe a couple of years ago. You cannot get to second base with your foot on first, meaning you have to take risk to get somewhere in life, in love, in anything. You have to take reasonable risk. So the US and the major developed countries and the major financial markets, London, Hong Kong, tend to be a bit more developed with risk taking and capital formation. They also tend to be much further along the alternative investment curve, if you will, than the rest of the world. And there's exceptions. But for example, hedge funds have been active among US investors since the 20 years I've been in the industry and probably years before that. But I took a trip to Korea to meet with investors about 10 years ago. Met with a lot of big endowments, foundations, pensions in Korea who have billions of dollars and collectively trillions of dollars of capital. And they were fascinated with hedge funds and very interested, but it was probably 5 to 10 years too soon. They just were not ready yet to get into alternatives because one of my favorite quotes, it's one of my own, the greatest force in nature is inertia. They say changing consumer behavior is often impossible, very difficult to change consumer behavior. Same thing with investors. The pensions, endowments, and foundations, we have been doing it a certain way for the past 50, 100 years. And when I flew to Korea for some phenomenal meetings with huge investors 10 years ago, they just weren't ready for alternatives yet. Now they are. So that's probably the differences that I see around the world. But a lot of the world has caught up. We have relationships with endowments, foundations, and pensions in Europe, in South America, in Latin America, I think everywhere except Antarctica. We have no investors in Antarctica yet. The penguins are not yet investing in hedge funds yet. Maybe next year, we shall see. But the world has caught up a lot with alternatives. But it's changed over the years, but there's still a bit more catching up in some of those areas, non-US, non-major financial markets. So I am going to open it up to more questions in 5 seconds. And before I stop sharing my screen, seriously, many thanks to the Boston College Investment Club, the leadership, the people who helped put together this Zoom and everything else, and all the attendees. I've got another 10 minutes if willing to do the AMA, the Ask Me Anything regarding hedge funds, alternatives, investors, fundraising, careers, anything else that may be on the table. And I guess I'll give it to Courtney or whoever's manning the mic or the Zoom, and I'll stop sharing my screen. I'll guess right now.